Hello and welcome to the NC podcast. My name is Natasha Collins and I am the founder of NC Real Estate, which includes its members club for landlords and property investors to come and build profitable property portfolios that completely align with their goals. I have a freebie that if you haven't got it yet, you definitely need to download it. It is my property investment expansion success formula. And to get it, you go to ncrealestate.co.uk/flowchart. I want you to pop in your name and your email address and I will send it straight through to you. Then once it's in your inbox, print it off, hang it on the wall so that you can keep going through it. I'm going to put the link to that in the show notes. So today I've got something really, really exciting. Somebody who I wanted to come on the podcast for a little while to answer questions that so many of you ask me on a, daily basis. So I've got Alice Williams here, who is head of property at Pilotfish. Hello, Alice.
Hello, thanks for having me.
No problem. We are talking everything all about finance today because Alice specializes in that and she does kind of the more hardcore finance, I'm going to say. you deal with everything, don't you?
Yeah.
All sorts of different loans. I will let you talk through the different funding options that you help with.
Okay, so we do, as you kind of alluded to, absolutely everything. My main focus is very much the bridging and development side, the fast pace, probably the largest scale, and the far quicker completions and more demanding to some extent. And then we've also got a team that does the investment mortgages side. So they deal with the full portfolio refinances, the buy-to-let lending, especially in limited companies, which is becoming a far more popular strategy now. So we do cover pretty much everything that an investor would need in their war chest, essentially, as part of the financing package.
Can you ever get 100% finance for a deal?
Yes, but you need the right parameters in place. So, For example, if you're purchasing significantly below market value, there are lenders that will go up to 100% of purchase, but they will do a large amount of due diligence on that. So that will have to be confirmed by a valuer that the current value is that you're saying it is to the lender, that it's a strong asset. So again, anything a bit quirky, you're unlikely to get 100%. But if it's a standard residential purchase, I don't know, it's a distressed sale because somebody's in maybe some bad debt, looking just to get the asset gone, pull some equity out enough to repay whatever they've got to repay, then that can be taken into consideration. You do need to make sure you go with the correct lenders because there are only a handful of lenders that will do the 100% because again, it's considered that higher risk lending, especially on the below market values. But it's speaking to the right people that know how to facilitate those. And if you're not purchasing below market value, 100% lending can also be done on those, but you'd look to use additional security. So for example, you found a property at auction that you really, really, really want to buy. You don't necessarily have 100% or the 25% required above and beyond the bridging finance to top it up. The majority of bridging finance providers can look to put second charges against other properties held elsewhere. Even your residential property, they can put a second charge against that to use some of the equity there to top up the funding to 100%.
Okay, and how much interest are we looking at this? Is it bad?
It's not horrible. So if you're purchasing below market value and you're wanting 100% purely secured against the main asset, so the asset that you're purchasing or you're looking to put finance against, you'll be looking at between 1.25% per month. So at the higher end. But if it facilitates a deal that makes you money and works, then it's very worthwhile. If you're doing 100% finance where you're remaining at the 75% loan to value mark on the purchase property, but you're using additional security from elsewhere, so you're using equity in your personal residence on a second charge or even across your portfolio, that will be standard rate. So that will be 0.7 to 1% because the lender doesn't deem it very high risk because the top up required, they're actually just pulling from somewhere else. It's not as if they're putting their necks on the line.
Okay. So it's possible and not as disgusting as I thought you were going to tell me it was going to be.
Yeah, no, absolutely possible. Absolutely possible. It's just having those open communications and giving yourself enough time. So it always makes it far more challenging if someone comes and says, right, we need 100% finance, we need it in 2 weeks. Whereas if you give yourself that breathing room to look at other assets that you've got, even something ridiculous like we had somebody with some unencumbered supercars, and you could raise equity against those supercars to top up the funding. So there are always ways that you can at least look at it, and probably solutions that don't even occur to you. It's just getting the right team and having those open conversations.
Okay. So what's the biggest error someone can make when they try and go and get finance?
I think the biggest one is being dishonest or withholding information in the fear that it will put you in a bad light. So the most common one is maybe when there is a couple of missed payments, even if it's not significant. I mean, we see everything up to bankruptcy. So a couple of missed payments in the grand scheme of things are nothing. But a lot of people maybe don't necessarily disclose that up front. And then it comes out when lenders are doing their due diligence, they're doing their credit checks against you. And it throws a bit of a spanner in the works. Whereas if everything is disclosed up front, we know the full picture, we're told about the missed payments or the CCJ or the default, you can make sure that you're put with the right lender or on the right path before you commit to someone. So I think the biggest thing that people can do is, regardless of whether you're going direct to a lender or whether you're going through a broker and intermediary, is to provide that full picture and be completely open, honest about the good, the bad and the ugly, because it means that you can get onto a correct product from day one without causing any delays where you find something negative out partway through the application process and you're pushed all the way back to square one again where you're having to look and picking other lenders. So I think the absolute must is being completely open about something. And that's far easier when you've got those strong relationships there and feel like you're dealing with somebody that won't be judging you. You won't be sitting there thinking, oh my goodness. And again, that all comes down to the strength of relationship.
Okay, that's very good advice. So I've had another listener question, and this is about securing finance. So in this person's case, they've had an interest-only mortgage with RBS, which reaches the end of its term in a year from now when the person hits 70. And it appears that lenders aren't interested in remortgaging lower valued properties for portfolio landlords. And basically, they're saying they have to find 50K or get repossessed. What would you advise them to do in that situation?
So it is a tricky situation because they have got quite a lot going against them. Being 70 obviously isn't within appetite of most lenders. And again, the lower value properties, a lot of lenders have a minimum loan size around the 100, 200,000 pound mark, but it's not a deal breaker. So there are lenders out there that can go up to aged 85 at the end of term. Okay. So even now, age 70, you could look at getting a 15-year product put into place. And there are lenders that will look at the smaller scale, especially if there's another portfolio there in the background. It may well be that you can even look at refinancing a couple of other properties just to get that minimum loan size hit. So there are a number of factors. One thing to consider that isn't actually covered in the question is whether or not it's limited company or personal name. In a way, limited company actually would help in this scenario because you could potentially bring in a successor essentially to show that there's clear succession planning there in the business, in the property business. So I think with a bit more information, there could definitely be a solution. It's just speaking to a professional and having those conversations to see what you can do.
Okay, so hopefully they're listening, and I'm going to put Alice's details below this podcast. So if you are listening to this, get in contact with Alice. I'm sure she'll be able to put you in the right direction.